you can get from Integrated Business Group, and we'll talk a little bit about that in the at the end of the event as well. But we're going to talk about why sales tax matters, sort of what's the big deal, right? And then talk about Nexus, which is a term that might be a little abstract for you guys, but I'm going to explain it to you, and hopefully you'll have a better understanding with Nexus. And then we'll talk about product taxability, use tax. Something that people are really not thinking a lot about because it's been ignored for a long period of time, but high on the auditor's chart is exemption certificates. And then we'll talk about, what happens, how do you prepare for an audit, or how do you avoid an audit, which is even better, right? And then we'll talk about services, which is something that's really ever evolving, again, as far as taxing goes, and then how to automate the processes. So why does sales tax matters? Well, of course, they're statutory, but in most states, and you'll see a graph here in just a moment, it's about half of the revenue for a state, depending on the state's taxable. There's only a few that don't have sales tax, but it offsets the deficits, right? It supplies us all the goods and services that are produced by our state. And there's a lot of challenges around that, and we're going to also talk about what happens if you do business as usual. So as I mentioned, about half of the revenue for a state comes from sales taxes, and we all know that it's much easier for them to raise a sales tax by 0.5%, and that kind of flies through the system, than it is for them to say, hey, we're going to raise your property taxes, right? So no one likes their property taxes getting raised, but they can usually, raise those sales taxes. And even more so than just the state sales taxes, we're going to talk about this as well, there's also the jurisdiction or special projects and things like that that occur, and then all of a sudden your sales tax rates go up. But that's something that's ever fluid, and it's very easy for them to change that. In most states, you do have to vote on those additional taxes, but sometimes they kind of slide through. But once again, very, very important to a state, and that's why they're really focusing on it. They can't increase taxes anymore, but what they can do is go after people they feel is not paying the appropriate amount of tax or avoiding taxes. So as I mentioned before, it's statutory. You don't have a choice. And you're always at risk. It will happen to you at some point. Some industries get audited more often, and we're going to talk about that towards the end of the segment. But there's always that opportunity for you to get audited. And of course, it typically results in back taxes and penalties. Rarely do we see, and that's when we get a lot of new clients, of course, is I'm getting audited, what do I do? Or I just got audited, I need to be compliant. And typically, always people get back taxes and penalty, unfortunately. But the challenge is it's very labor intensive. It's interesting, when I came to work for Avalar, we have to go through extensive training. And one of the parts of our training is that they give us a couple exercises. Say, I'm selling this particular item, and I'm shipping it from this state, to this specific address. And we want all of you to go into all the states that are involved, into their tax websites, and determine what the taxability of this item is, or if it even is taxable. So when we go through these exercises, and we're all feeling pretty smart, they give us about an hour to go through them, and they go over the answers, and of course everyone's wrong. And they said they've never had a class where anyone was ever right, because it's that complicated. So it takes a lot of work and a lot of expertise to be able to manage and accurately calculate sales taxes. Unfortunately, it's kind of painful. But I have an answer for you at the end here. I'll share that with you. But as I said, it's expensive, and it's always in flux. So over 14,000 changes in 2014, and we're even exceeding that this year, actually. So pretty painful. And you know what? It's a non-revenue generating activity. So I don't think anyone's ever had a customer who says, hey, you know what? I buy from you because you calculate sales taxes better than anyone I've ever seen. But we have had many people come to us and say, my customers are beating me up because they know that I'm charging them the wrong tax. I'm charging them too much. And I'm losing customers because of that. So we do have that scenario. It is a scenario that is, somewhat competitive, if you will. So it is important to charge the correct taxes. And then when we started researching for this book, and we have constant research going all the time, but we started working with Wakefield to get some statistics that we could use in the book. And they said that they've done this research, and 44% of the people can't remember the last time they updated their sales tax process. Now, I've been in the financial services industry and business consulting as well as working for vendors for over 20 years. And I used to be a consultant, and what we would typically do is we would go out, we would set up one of our client systems, and we would download tax tables, and we would determine if their customers were taxable or not, their items were taxable or not, and we'd call it a day. And then we would come back at the end of the year and help them with year end, and we would do the same process. Well, you know what? That's not good enough, right? And even a lot of other companies said, I can't remember the last time I did that update. So it's pretty important, of course. And then 48% said, you know what, I bet you if the auditor came today, I would have a problem, right? They'd find some mistakes and inaccurate information. And then also Wakefield determined how much the cost to manage an audit. So we're not talking about back taxes or penalties. We're talking about just the process of having all their people doing the research and perhaps having temps come in and pulling all the documents, making copies, and doing all the things necessary to support that audit. Is costing about $114,000 in expenses just to manage through the audit process. So it's pretty painful numbers, so we want to try to avoid that for our clients. So when we look at sales tax compliance challenges, here's one of the problems. So there's 150 million, there's more than 150 million mailing addresses in the U.S. And within those mailing addresses, there's over 12,000 jurisdiction rules, so sales tax jurisdiction rules. And there's 35,000 sales tax use and rental rates. And of course, there's about 30 million products that are out there. So it becomes very, very complex. And then you add on top of that people that have different types of exemption scenarios. It's a big matrix of very confusing information. The map behind here is actually an illustration of the sales tax jurisdictions, and you'll see, I know most of you guys are in Florida, you can see the tail of Florida there. You see that there's many jurisdictions in Florida. So what does it look like for a company to manage this process? And most mid-market companies, mid-sized companies, say it takes about 11 hours a week to file, remit, and do all this research and different things, manage exemption certificates and so forth, to try to be compliant. So it's a very expensive proposition and very time-consuming. So when we think about, so okay, now we understand the complexities and the why there's taxes and why it's complex and why it's important. Let's talk about what is Nexus and what does it mean to you? Do you have a Nexus scenario that you might not be aware of? So let's talk about that. So when we talk about that, we're also going to talk about what are the right questions to ask. And one of the things as well that you can get from Integrated Business Group is a Nexus survey, which will help you determine if you still, after this meeting, are on the fence about, do I have Nexus or not? It'll help you determine that. And of course, we can help you with any questions you might have that might be complex. So we're going to talk about these different things. So what is Nexus? So Nexus is loosely defined as a connection between a state and a business. So what is your liability or your connection to that state? So when you have Nexus, it can mean that you have an obligation to collect sales and use tax on out-of-state transactions. And the ruling that was created initially is that you must have a physical presence. There was a lawsuit several years ago, and for those of you who have been around as long as I have, you can probably remember Quill, which was an office supply company. And you would get the big Quill catalog in the mail, and you would go through and you would order your supplies. Well, the state of North Dakota said, you know what, these guys are shipping product into my state, and they're not just taking revenue from my local office supply companies, but they're also not paying sales tax, and we're not going to stand for it. So they filed a lawsuit against Quill and said, hey, you know what, you have to pay taxes in my state. And this became like a benchmark lawsuit that occurred. And this is where the whole concept of Nexus and that term, you have a physical presence in the state. So initially, and of course you think about in those days, it was literally a physical presence, right? Or you were shipping to, you had delivery trucks delivering things to that state, or you had an office or a distribution center or a warehouse in that state. And so it was once again loosely defined and up to each state to determine what a physical presence was. So that's where the trouble comes in. And it's never been well, it's been revisited several times, but it was determined that every state can make their own decision about what a physical presence is. So here's some of the things that states determine as a physical presence, and this is ever growing and it varies by state. So of course, if you have, physical presence, a warehouse or something of that nature, that's obvious. But do you do maintenance or service or repairs into that state? So I sell a good into that state. I sell a copy machine. And although I don't have a warehouse or distribution center in that state, I do maintain and repair that machine in that state. In many states, that would be considered having a Nexus activity. Do you own or lease real property, so a warehouse or something of that nature? A hosted data center. Do you have field service staff? And the ones I think are just really interesting are, have you done a trade show, right? So there's a few states that certain companies will not allow their employees to go and attend or participate in a trade show because it would constitute Nexus in a state that they don't want to have Nexus in. So it is perceived by those states who determine that trade shows are Nexus activity that you're coming to my state to drive business into my state. So therefore you have Nexus, right? Do you have commissionable people? Do you issue 1099s to people in that state? So you have a sales rep or someone like that who does work on behalf of your company. Do you have investors or board members in that state? I think that one's just really bizarre, but it is what it is. Or do you do web advertising? We're going to talk about that in just a moment, what click-through Nexus is, which is an interesting one. Or do you do drop shipments? Do you use third-party warehouses? That is becoming a very big deal. And specifically, if you sell through the Amazon Marketplace, you do fulfill by Amazon, they have 11 warehouses. And if you use Amazon, you have Nexus in 11 states because you're doing fulfillment by Amazon. So as soon as you do that, you have Nexus in 11 states. So it's one of those double-edged swords. It's a great opportunity for small businesses to sell their goods in a different way, but that does constitute Nexus. So it's complicated, and that's why we help our clients and customers and prospects to determine, do they have Nexus in these states, because it is very, very complicated and ever-changing. So as I mentioned before, you can no longer assume that what was determined when Quill versus North Dakota about that physical property scenario, that's true anymore, because it does have these other softer methods of determining whether or not you have Nexus, once again, based upon the state's interpretation. Affiliate Nexus. So that is a situation where you have, say I produce machinery, farm machinery, and I have distributors or dealerships, so that's affiliate Nexus. So although I don't physically sell my farm machinery in that state, my distributor does, and therefore I have Nexus in that state. As I mentioned before, trade show participation, and then the Amazon laws. So 11 states, you automatically have Nexus in 11 states if you use the Amazon Marketplace. There's also an interesting study done by the National Federation of Retailers that there's a lot of folks who sell goods through Amazon or sell through goods online that are not paying taxes. So they said 70% of the companies conduct sales online, but only 47% of them are remitting their sales taxes to a single state, much less multiple states. So that is an area that auditors are really scrutinizing, and they're all over it. So they are clever now, and they go to your websites and they look to see if you sell goods online. They look to see if your goods are available through Amazon Marketplace and things of that nature, and then they come to visit you. So it is a very, like I said, it's a challenging thing. It's a double-edged sword. It's great to have that mechanism, that outlet to be able to sell your goods in a different way, but it does mean that you have Nexus and you have a tax liability scenario. So that's a little bit about what is Nexus. I hope that clarified it a little bit. And it is something, unfortunately, that is clear as mud, right? But that's some of the things to think about. You know, do I have relationships with people that are selling my goods? Do I have a third-party logistics company working for me? Do I have a distributorship? Do I have sales reps working those territories and things of that nature? But once again, we can help you if you have any questions. And of course, we can do the Nexus survey with you as well. So next, we'll talk about jurisdictions. So now that we've determined what that scenario is around taxes, let's talk about the really drilling down into what taxes are determined. So it doesn't always follow zip codes, and that's what a lot of folks are currently doing. Zip codes at one time were fairly accurate, but unfortunately, as I mentioned before, you know, a lot of states or a lot of towns have their own special taxes, and the cities and the municipalities have different taxes, and they add them on. So the zip codes doesn't work anymore. So individual counties, as I mentioned before, they can add to it, and it significantly changes within a zip code. I'm going to show you an example here in a moment. And I have someone that is, I'm hearing a little background noise. If you'd mute your phone, please. So this is an example I think is an interesting one. We have many of these that we do, and I always tease, it's like, I wonder, you know, these different houses, right, that are just little pockets of people in this map. It's like either they have friends in high places or they've really upset somebody. But in this illustration, these folks have one zip code, and they fall into 4 different sales tax rates. So I'm thinking that one of these guys on the block is probably getting a lot of drop shipments to him. So, you know, people are saving. Actually, the variance in this one is between 4% and 7.75%. So that's pretty significant. So 3.75% difference in tax between one guy on this street and another guy, and that's pretty big. So it's very important when you think about, you know, are you compliant? Are you looking at down to the rooftop level? It's called rooftop level compliance, and that's what auditors are looking for. And we do that, of course, in our system. And in fact, our technology is so good that most states use our rooftop tool to determine taxability for themselves. So when they go out and do audits, they use our tool to determine what the rooftop liability is for that tax. So when we talk about product taxability, this one I think is really, really interesting and complex at the same time. And frankly, I never knew this. You know, many years ago, like I said, we would go out and say that the item is taxable or not, the customer is taxable or not. Here's the zip code, so here's the tax rate. And I never knew that there was nuances in product taxability based on states. So here, I'm going to give you some examples. You're going to see some that are really, really very abstract. So they vary between states. And here are some of the industries that there's a lot of varying taxability. So software, and that's a really interesting one now, digital goods behind it there. So one of the things that's very challenged right now, and in fact we're getting ready to do some thought leadership series on this, is around digital goods. So if you think about at one time books, right? You go into a bookstore, you buy a book, excuse me, or you'd even buy one on Amazon, and it was a tangible item. So it would always be taxable unless it was a religious book or a school book. So now when you have these downloadable assets, every state is trying to determine, is that a taxable good, right? So conceptually, if it wasn't a downloaded book, it would be a physical book and therefore a piece of physical property, most states determine. But there's some states, which surprisingly enough, California is one of them, who don't tax downloadable goods. So software, of course, falls into that category as well. So, you know, most software, you don't get disk anymore. You don't get the, you know, anything. You really download the software, and is that taxable or not? So every state has their own interpretation of downloadable goods, and it becomes complex once again. And then services, we're going to talk about services in depth here in just a moment, because there's so many nuances around services, especially if you sell a good with that service. Medical devices and equipment, once again, different perceptions about the usage And my favorite, of course, is clothing and apparel, because there's all kinds of nuances around that. As an example, in the state of New York, if you buy clothing and the individual item is less than $110, it's considered a necessity. But if that good becomes $110.01 or more, it's a luxury good, and therefore it's taxable. Belts. There's 27 different tax rules around what is a belt. Is it used is it used as part of a uniform, and therefore it's not taxable in a lot of states? Or is it just a good to hold up your pants, right? Or is it something that is used, for some sort of safety item? So there's a lot of variances around different apparel goods as well. So here's some of my faves. So Hershey's milk chocolate bar is taxable. It's a candy. But if you buy the cookies and cream one, because it has flour, it is tax exempt in most states. And so one's considered a food and one's considered not a food. Rockstar energy juice drink is non-taxable, or is taxable rather, because it is non-carbonated. And your Frappuccino from Starbucks is exempt in many states because it is not carbonated, but it has a nutritional label. So interesting, one's considered a supplement, one's considered nutritional. I think that's kind of funny. But in any event, that determines its taxability in different states. There's many, many examples that we use in the state of Colorado. If you buy a soda to go, the cup and the soda is not taxable. The lid and the straw is taxable. In the state of New York, if you buy a bagel, it's considered food. It's not taxable. If someone slices that bagel, it's a good example of services. If that bagel sliced because the service was involved, it becomes taxable. So just a lot of crazy little nuances. Every state, I think they have a little group of people who create some of these abstract laws, but it is very complex. And then there's use tax, and this is the thing that I think a lot of folks have the most confusion about. There's a couple flavors of use tax. So let's talk about the difference between what is sales tax and what is use tax. So sales tax is, I live in Atlanta, I live in Georgia, so if I'm selling something to someone in Macon, Georgia, that's sales tax. If the item is taxable and the customer is taxable, I collect the sales tax and I remit it to my state. Then there's seller's use tax. This is the one that most people are confused about. So seller's use tax, so I live in Atlanta, I'm selling a good to Florida, to one of you guys in Florida. It is taxable, and you are a taxable customer. You're not tax exempt. So that's an intrastate transaction where I have to collect because I have Nexus. I sell a lot of goods in Florida. This item is taxable. You're not tax exempt, and I have to charge you tax in Florida down to your rooftop level. That is a seller's use tax. Okay, so a lot of folks think sales tax is no matter where you sell it, and then use tax is what you consume, but it's actually called seller's use tax when you sell something out of state. And then use tax is when you purchase goods or supplies from out of state and you use them in your business, as the first example. So I buy office supplies and I use them in state. Now, conceptually, what is supposed to occur is if that person did not charge me tax and I'm not tax exempt as an entity and I'm using these goods and these are tangible property, I'm supposed to calculate for myself, so I'm supposed to self-assess the cost of the tax and remit it to the state when I remit my sales taxes. So that's use tax. So that's the use tax that there's a line item on your form. So that is what's supposed to happen. Most folks don't do it, but that is what's supposed to happen. Or it can also be a withdrawal of inventory. So say I sell janitorial supplies, and it's typically a taxable item, so I sell paper towels and this, that, and the other. And I take a case of paper towels out of stock and I use them internally. So that's a withdrawal of inventory for taxable use. So that's the three flavors of tax, so the sales tax, use tax, and seller's use tax. So I mentioned before exemption certificates. This is something that was really off the radar for many years. So all of us in business, I know you have folks that you sell to that are perhaps an exempt entity, so a school or a church or something of that nature. But then you also have folks that perhaps have an exempt usage. So maybe you're part of a supply chain. So I make bicycle wheels, and I sell those bicycle wheels to the company that then makes the bicycle. So typically, they're a reseller, right? So they're a reseller. So they would have an exemption certificate as an exempt reseller. So when I sell them bicycle wheels, they're exempt. On the other hand, if I was to sell them something else that was not resold, that would not be tax exempt. So that's one of the areas that is scrutinized. So sometimes people give you an exemption certificate. It's not a blanket, right? So it's not everything they buy is tax exempt. It's specific things that they would resell in that scenario. It's a very abused thing. I see it all the time, even as a consumer. You'll go out and you're buying something, the guy in front of you whips out an exemption certificate, and he's buying something at Best Buy or something like that, and he's not really exempt for that thing he's buying because he's not reselling it, but the company takes it and so forth. So it's being audited a lot. It's highly scrutinized. Very important to be on top of this. So as I mentioned before, customer-based exemptions, and then making sure that it covers the products and goods that you're selling them to, and just that, not other things. Now, the other thing that's also important to know is that they're changing the rules about these certificates, and they expire in most states. So as an example, in Alabama, they expire every year, and they passed a ruling this year that if you're caught with expired certificates, not only do you have to pay the tax on all the goods you sold to that person this year, they'll go back 3 years, by the way, but you also, if you're found to be grossly negligent, which, once again, that's up for interpretation. So say you don't have any valid certificates for any of your customers. If you're grossly negligent, they can prohibit you from accepting resale certificates or exemption certificates for up to 3 years. And of course, they fine you as well. So it can be very, very stiff and very impactful to your business. So it's very important, once again, just a tip from me to you, make sure that you have this stuff under control. Make sure they're accurate, make sure they're up to date, understand the ruling of each state that you have exemption certificates for, and make sure you can find them. That's the other thing. People typically can't find them when they have an audit. So make sure that that's something you can easily manage, or not easily manage if you have a lot of them, but something you can manage and do something about. So what happens when the tax guy comes, when you get that lovely letter and they're going to come to visit you? So let's talk about how we can keep the pockets empty and also reduce some of our audit list. So the thing that I mentioned all along in this presentation is many states are getting pretty stiff about this. There's 36 states that have a deficit in their budget. And so what's the best way to get money? Let's go after the people we feel aren't paying taxes, sales taxes specifically, and recoup some money. So California announced they're hiring 100 auditors. They did an exercise where they had some temporary ones, and they have more than paid for themselves. So they're hiring them on full-time, and it's going to be a lot of interesting activity out there. I've spent a couple weeks out there with one of my peers, and we visited some CPA firms, and it was very interesting. I was hearing a lot of stories about a lot of folks that were getting audited and some of the themes behind it. And they do go sort of in themes. So when they determine that there's a specific industry that is typically have misunderstandings about what is and is not taxable, then they start going after everyone in that industry. And specifically, the one that was one of the CPAs talked about was veterinary clinics. So a lot of you have pets, and you know that when you go and you take your pet and you buy medicine for them, like heartworm pills or flea drops or whatever the case may be, the stuff you take home, they typically charge tax on it. And that makes sense, right? But what was discovered was the items that you use in treatment. So say you take your dog in and he has to have a cortisone shot. Well, that is supposed to be taxable. And most vets were not charging tax on it. They were, making it part of the service, if you will. and they weren't charging taxes for the medical medical things that they were using in treatment. So everything that they use in treatment was supposed to be taxable. So so all of a sudden then all the vets get audited, right? Because they think that all the vets don't understand that this is taxable, and here's a theme that we have an opportunity and let's go after these people. I had a partner in South Carolina that's a CPA firm that had a dentist, and this one was kind of interesting. So dentists, when they fill teeth in South Carolina, the fillings are taxable, and a lot of dentists weren't charging. So once again, they started auditing all these dentists. And this guy, my partner specifically, had a lot of medical practices as part of his client base. And he said, he goes, it's an interesting story, he goes, one of my dentists is a pediatric dentist. And he filed suit, and he argued, he challenged the audit and said, because I'm a pediatric dentist, when I do fillings on a tooth, it's a baby tooth, it's going to come out, it's not a permanent structure. And that was the ruling, that it was considered a permanent structure. He goes, it's not a permanent structure, they'll lose that tooth, and therefore I should not charge tax. And so the initial auditors, like, okay, I buy this, but I have to run it up the flagpole and see if they'll, will pass into the state, and they denied it. But I thought that was very clever, and it was kind of an interesting a study on how you can interpret the rules, right? At the end of the day, it's up to someone's decision. It's not very clear, is that considered a permanent structure? So anyway, he had to pay all the back taxes on that. So very important to understand it. And as we all know, it's probably really hard to go back to your customer and say, hey, you know what? I didn't charge you tax on these transactions, and would you mind paying me that tax because I have to pay it to the state now? So good luck on that one. So the best thing, of course, is to be prepared and understand in advance what is and is not taxable. So some of the common mistakes, failing to file a return. One of the things that we see a lot with folks that are new to filing in multiple states is, say you don't have any transactions for that quarter, and so therefore it's like, well, I don't need to file because I didn't have any transactions. Well, guess what? You have to file a $0 return, or you will be a red flag that will come after you. Failing to report sales, of course, it needs to tie out, and they do tie it out at the end of the year. These states do tie it out to your federal income tax returns, and they say, well, you know what? If you had this much taxable goods, or you had this much goods that you sold, and you're just reporting this little bit to the states, then something's wrong. Excessive credits, returns with errors, especially if you've been audited and you continue to make the same error, then they will definitely come after you again. As I mentioned before, it doesn't match other records. Repeating mistakes found in previous audits, as I mentioned before, and that exemption certificate misuse. That's, once again, a big red flag these days. And not reporting your use tax. They know everyone has it, so do yourself a favor, periodically report some use tax. So to sort of proactively prevent it from happening, do a Nexus study. As I mentioned before, we have a tool that will help you. Integrated Business, as well as Avalara, is more than happy to help you, free service to determine where you have Nexus. Stay up to date with rate and rule and boundary changes. You can go to every state and go to their website, and you can sit and read through they're called rulings. They're a lot of fun to read, and as I mentioned before, up to a lot of interpretation. So they are a bit challenging. Report your consumer's use tax and be compliant from day one. I find a lot of folks in my line of business, I find a lot of folks that are like, well, we've been in business for 2 years and we haven't done anything yet. But we know that we're really, in a big risk situation, so we better get something done. So my challenge to you would be try to start from day one, right, in a new business, and try to avoid ever having that risk exposure. And then automate with technology. I'm going to talk about that in just a moment because that's sort of the secret sauce here. And then make sure you have an understanding of what your filing requirements are. Every state and jurisdiction has nuances, and sometimes it's depending on the threshold of revenue that you generate in that jurisdiction, and sometimes they're just random, right? So some is quarterly, some is biannual, some is annual, some is monthly. And some of them have you calculate a percentage of expected taxes in the future, which is really interesting. Make sure you're at the rooftop level, not just the zip code level, and really understand your product taxability, and make sure you're isolating your items in a way that you can capture them, the proper taxability depending on where you sell. And keep detailed records, of course, and a process for managing your exemption certificates where they're at your fingertips when the folks come to visit you. And as I mentioned before, services, these are a new area as well that auditors are looking at, because we're seeing a lot of folks that are kind of bundling services. So let's talk about that. So the first thing, of course, you need to understand the difference between a tangible personal property. So that's a physical good, right? So that's a book or something you can touch. And real property. So of course that's real estate and physical property in their territory or in their jurisdiction, and then professional services. So states, of course, they determine taxability differently as well. So here are some of the commonly taxed services across a lot of the states. So you see that they're kind of interesting, a variety of choices here. And the biggest thing that we're seeing is folks will bundle a service. So you're buying a good and the installation of that good or the service of that good. And it's being sold as a single line item. So that is a challenge. It's very important to break them out separately. Even if in your home state it's not a taxable service or that good is not taxable, do yourself a favor and always make sure you isolate the item from the service in a separate line item. Because when you bundle these, it becomes problematic, and different states will start looking at those items and come back to you and find that a piece of it was taxable, or everything is taxable because you bundled it together. So it's kind of a bit of a challenge there. So as services become more and more important, they're also scrutinizing them and saying, hey, you know, we should be getting taxes on them, right? It's kind of interesting. So a standalone service, however, is up to a state's discretion, and every state has a different ruling on what the services are. So and that list I showed you a minute ago, that's just a few of them that are considered to be taxable services. And then again, as I mentioned before, if you bundle a service with a tangible property, it also compounds the challenge, and we're seeing just, you know, a ton of folks scrutinizing that. So the good news is there is a very easy and inexpensive way to automate all these processes and take the burden off you guys. But we'll talk about the steps before you automate and when it makes sense, right? So we're not saying that Avalara, who provides this cloud solution to do all these things, is the right thing for you. We're just saying that we're going to walk through the when it makes sense, if you will. So of course, automating the process saves time and increases accuracy. It mitigates your risk. So we assume all the risk. We guarantee our calculations. If you're ever audited and you use our service, we stand there beside you and we support exactly why that particular tax was charged to that particular item in that jurisdiction. So we guarantee all of our calculations. So like I said, not everyone needs our service, but you know, to determine if you need automation, you need to estimate what your tax leakage is. So have you had any audits, interest and penalties and so forth? What is the time value of money used in these tax assessments? You know, are you overcharging customers? Are you undercharging? Are you getting feedback from your customers that they're having issues? Now, the other thing too that can happen is we talked about that use tax scenario where if you buy a good from another state and they don't charge you tax and you should self-assess, well, it happens on the other side too. So say you sell to a customer, you didn't charge them tax, they get audited and it's determined you should have charged them tax. They're going to come and start looking at you as well. So it's kind of one of those sort of double hit there. So a lot of companies are concerned about you charging them sales tax, which is kind of interesting. And then determine what your tax process costs are. So how much time are you guys spending trying to be compliant? And if you're not spending time trying to be compliant, of course, understand the cost of the risk that's involved in you not being compliant. And then also think about what the impact would be to your cash flow. So if they're rebutting any of your sales tax calculations and not paying the bill because, hey, I'm exempt, or hey, you charged me the wrong tax. In some companies that never happens, but it does happen in some companies that have a high volume of transactions. So what does get automated though? So it's the calculation, the reporting, returns, and remittance. So all the Nexus rules are applied. Our solution sits in the cloud. At the minute a change occurs in any jurisdiction or an item taxability, it is updated in our system, so you always have the most current information. And we look down once again at the rooftop level. As part of our product, and this is sort of just an additional benefit, we also do address validation. So for us to be accurate, we need to validate that address. And some folks use this just for that piece, which is kind of interesting. We take it down to the extended zip code, and we correct any address. So say I put in an address that was incomplete. You know, if any of you have been to Atlanta, you know we have 100 different streets that have Peachtree in the name. So if I put the address was 1222 Peachtree and left it blank, it would do a search against addresses to determine what the correct extension, Peachtree Road, Peachtree Street, Peachtree Parkway, and so forth, and it would determine which one was correct and return the correct value with the correct zip code and calculate the tax, of course, correctly. And then we would also look at what the client's exemption rules are. Are they exempt? If they're exempt, are they exempt for what products? And then what is the product taxability, right? So once again, we get very finite with you and your items to make sure that they're isolated in a way that we would be able to maintain it for every single state in the United States and be able to isolate that item in their taxability scenario for every single state. And then apply the jurisdictional sourcing rules. And as we talked about before, taxing jurisdictions are not zip codes. We take it down to the rooftop. So all of these things work in the cloud and work with a lot of different things. We have a direct integration with Great Plains. I think a lot of you guys are on Great Plains. That's what we use internally, actually. Great Plains is one of the first solutions that we provided integration with because we use it as well, and we have an incredible solution for Great Plains. In addition, we also integrate with a lot of e-commerce solutions. A lot of folks have e-commerce stores using Magento or WooCommerce or one of the other solutions, and we integrate to all of them as well as other point-of-sale systems. We integrate with over 400 ERP and e-commerce solutions. And we also take that information, you have it on a dashboard, and we would also generate your returns. We file them electronically, and we can remit to every state and every jurisdiction as well. If any of you guys have the extreme pleasure of doing business in Alabama and filing sales tax returns, you probably know that every jurisdiction requires you to remit your return individually to every jurisdiction, as opposed to a lot of states let you just send in one return to the state and then they filter it down to the jurisdiction. So it's kind of painful in some states. We also provide services for things like W-9s and 1099s as well. And that just brings me to one of my other little reminders. At the end of the year, are you ready for 1099s? We have a service that lets you, for less than $2 a form, create the 1099, does the taxpayer ID validation to match your vendors and your end users, and it distributes them electronically or by print and mail and files them with the IRS. So we have that service available as well. And so that brings us to the end of the presentation. So if you've had any questions along the way, I don't see any questions. I can see the dashboard now, actually, myself. I don't see any questions, but if you have any, I don't know, Amanda, can you unmute them, or we can also have them type a question in the chat box there.
Yes, I'm going to go ahead and unmute those who have speaking capabilities right now.
So as she's doing that, as a reminder, if you need a Nexus study or if you want the downloadable version of the For Dummies book, you can reach out to Amanda, and she'll be glad to provide that to you. And we would love to have a conversation with you and help you answer any specific questions about your business and make sure that you guys are compliant and prepared for, unfortunately, the inevitable. Okay, I think a lot of you guys are unmuted now if you have any questions you'd like to ask.